ClearSecure is a high-growth business whose stock has done nothing but go down since it came public in 2021. Yet this company is growing like gangbusters, generating free cash flow, and still has a huge opportunity ahead. Here's why we'll be buying $250 worth of this busted growth stock for our public portfolio today. Thanks to Commonstock for sponsoring today's video. As of the time of this recording, I do not own shares of ClearSecure.
And I do not own shares of ClearSecure either, a stock trading under the ticker symbol UYOU and valued at roughly $4.2 billion.
ClearSecure's mission statement is to enable frictionless and safe journeys using your identity. This is simple, inspirational, and optional, and the company does a great job of communicating this consistently. Using the company's technology is quite simple. You go to one of the terminals, you fill out a few questions, and the next time you go to an airport, you can use the company's technology to quickly get your identity verified, which speeds up the check-in process.
By using a scan of your iris and fingerprints, this technology can be applied outside of travel as well. For instance, ordering an alcoholic beverage at a sporting event, virtually queuing yourself in line before you get somewhere, or checking into things like hotels, offices, or events.
This is a subscription-based business, so a key metric to investors to watch is total cumulative enrollments. This figure has continued to march higher over the last couple of years and currently stands at about 14.2 million.
It's also important to keep an eye on the cumulative number of total uses for the platform. Of course, using it inside of airports is the primary use right now, but that should march higher in the future, and today it stands at roughly 118 million uses.
Since this is a subscription-based business, a key metric for investors to watch is net retention. And while this number might not be as high as it is for enterprise software companies, coming in at 92.4% recently, this figure is very respectable.
There's some other things to like as well. Customer acquisition costs are actually relatively low. That's because ClearSecure's real estate inside of airports makes it relatively easy to recruit new users. Customer demand is medium because, as we saw during the pandemic, and as we can assume would happen during an economic downturn, paying a subscription to this might fall off the wayside in tough economic times, but the majority, in fact, all of the company's revenue is recurring in nature.
So turning to the company's moat, we think that ClearSecure has several moat categories that are working in its favor right now. The most important one for investors to keep an eye on is the network effect, which we think is medium right now, but could become substantial over time. The network effects here are very clear. The more people that sign up for ClearSecure, the more airports and stadiums want to use this technology to verify identity.
We also think it's worth pointing out that there are some switching costs involved, although they are very low. And that's because right now, ClearSecure is the only way that you can speed up the identity verification process at airports. And if you're dealing with the world's busiest airports, that can make a big difference in your wait time.
We also think there's an argument to be made that the company has some intangibles working in its favor. First would be the company's brand name, and second would be the relationship that it has with governments. This technology has to be approved by several governments along the way, and we think that that would be very hard for a competitor to match.
And when you add the varying levels of these different moats together, we believe that the moat is expanding over time.
But how do the financials look? Well, it's a little bit confusing and they are mixed, but we think there's more good than bad. First, let's look at revenue growth, which has been very high over the last couple of years, coming in at more than 35% annually. Gross margin here is a respectable number at 62.2%, although net income looks like a horrendous figure, coming in at negative $71 million over the trailing 12 months.
There is, however, a big difference between net income and free cash flow, which has been growing and is significantly positive right now. The reason for that difference? Stock-based compensation. The company's balance sheet is in stellar shape, but returns on capital, because net income is negative, is also negative.
But how about management? This company was founded years ago by two co-founders, one of which, Karen Seidman Becker, is currently the company's CEO.
While we love to see that, what we don't love to see is that employees aren't enthusiastic about working at the company, earning pretty low scores on Glassdoor. Now, that's not terribly surprising given that most of the employees work based off of commissions and in airports, and that can be a tough job, but we'd love to see this move higher. On the other hand, both of those co-founders who are still on board have a very high level of skin in the game, which we love to see, with all insiders combined owning over 1/3 of the company.
Turning to potential, we do think there are low levels of optionality in the business. The company is currently very focused on identity management at airports right now, but as we mentioned, it could be used at stadiums, office buildings, restaurants, and more into the future. The company doesn't break out how much comes from that category right now, so this is more a potential option optionality as opposed to true optionality.
Looking ahead, we think that there's a ton of room for operating leverage to kick in moving forward, especially because of that stock-based compensation. In terms of the addressable market, management nor analysts really have a good beat on how big this market could be, and a lot of that will depend upon whether or not this is adopted outside of airports, but the vast majority of this growth is organic in nature, which we love to see.
ClearSecure has partnered with TSA PreCheck to integrate both of these technologies, which could make it very easy for consumers to breeze through airport security in the future. This partnership has been several years in the making, and once it goes through, could significantly add to ClearSecure's moat.
So how is ClearSecure done on the public market? In a market that's down 9% since coming public, ClearSecure's shares are down 31%. And in terms of meeting or beating analyst expectations, it has beat those expectations in 3 out of the last 4 quarters, and in the other one, it met expectations.
In terms of returning capital to shareholders, the company does not have a buyback program in place, and it doesn't have any debt to pay down. It did issue a special dividend to shareholders in November of 2022. However, since that's not a regular dividend, we're not going to give the company full credit for that. But we do like seeing that it is interested in returning capital to shareholders.
How about risks? Well, one of the things that we want to call out is that we think competition is actually very low. ClearSecure won the battle to win valuable real estate inside of airports, and we don't see any federal government agency allowing another company to step in at any point in time. So in terms of the biometric subscription area for airport security, we think that there is not much competition at all.
One risk we do want to call out is this company has been diluting shareholders like crazy since it came public due to high stock-based compensation, as well as selling warrants to some of its travel partners. We expect that dilution rate to come down over time, but this number has been very high in the year that this company's been on the public markets.
As we saw during the pandemic, we know that it can also be affected by outside forces, as the number of people traveling and the number of people paying for a subscription went down during that time frame.
Finally, while the stock has been falling since it came public, the valuation is still a little bit rich when viewed historically. So it's possible that investors like us could be overpaying for the company's growth prospects today.
Let's turn to how ClearSecure has performed in the most recent past. Revenue in the most recent quarter came in at $116 million, which was up 11%, and that beat both Wall Street's and management's own guidance.
Earnings per share came in at 5 cents on a non-GAAP basis, which is a nice turnaround from the negative number reported the year ago period. What's more, that figure easily exceeded Wall Street's estimate of negative 4 cents per share.
If we go ahead and look at margins, there's a lot going on here, all reported on a GAAP basis. Gross margins went up. That means that those agents that are recruiting people to use the service in airports were more productive. Operating profits, however, went down. Stock-based compensation is a huge part of that. And then because of some wonky one-time things with non-controlling interests that have to do with the corporate structure of ClearSecure, net margins went down, but weren't nearly as bad as what operating margins were.
Free cash flow during the quarter plunged to just $5 million, while net income on an adjusted basis actually came in at positive $8 million. And the balance sheet, as ever, remains perfect, $671 million in cash, 0 debt.
For the fourth quarter of 2022, management said that they now expect there to be $124 million in sales. That's up 54% versus the same time in 2021, and that was better than Wall Street was hoping for. They don't provide earnings per share guidance, but Wall Street's expecting 5 cents per share on an adjusted basis versus a loss of 9 cents per share in 2021.
Management does not provide guidance for the full year, but Wall Street is currently expecting 69% top-line growth to about $429 million and 6 cents in adjusted earnings per share.
So as shareholders, what will we be watching moving forward? Well, the first thing is bookings. This means the amount of money the company has collected for their subscription services on an annual basis.
The second thing we're going to watch is net retention. We want to see this figure stabilize at 92% and potentially tick higher over time as the world continues to open up.
Third, we're going to keep an eye on free cash flow. While the company is losing money on a net income basis, it's making money and growing its free cash flow hoard, and we want to see that continue.
Fourth, we want to hear more details about the TSA PreCheck rollout. It's going to be in its infancy in 2023, but this could be a major growth driver of revenue into the future.
When you add all those things together, we believe that the company's moat is stable, if not widening over time, and the thesis for owning the stock is on track.
So how'd the company score on our investing frameworks? The answer answer there is good. On mine, it got a 78, which is well into my investable category.
And on mine, it got an 8. It's worth noting that if Glassdoor scores were better, and if the company can prove that this can be used outside of the airport, that score would improve dramatically.
And when we think about the company's income statement, it's really only optimized for revenue and gross profit right now. For that reason, we think that the most useful metrics to look at are the price to sales ratio, the price to gross profit ratio, and the price to free cash flow ratio.
On a price to sales ratio, ClearSecure's stock is trading for about 6 times sales. That's definitely high on an absolute basis compared to the rest of the market, but as you can see, is relatively low in its young life as a publicly traded company.
ClearSecure's gross profit has consistently been increasing since it came public, currently clocking in at $242 million on a trailing 12-month basis. When you divide that by the company's market cap at about $4.2 billion, that gives us a price to gross profit ratio of about 17. That's a high figure in absolute terms, which shows that this company is still trading at a premium.
We don't have a P ratio for ClearSecure right now, but on a forward adjusted basis, ClearSecure is trading for about 91 times earnings. That is very high for any company, but again, this is not optimized for earnings at this point.
Finally, if we look at the price to free cash flow ratio, this company is trading at just under 25 times. That's not all that crazy, given that we think this company could grow at a double-digit rate for a long time to come.
So there you go. That's why we will be purchasing $250 worth of ClearSecure stock in our public portfolio, which you can see over on Commonstock.
If you want to follow all the purchases that we've made, click the link in the video description and head on over to Commonstock. You'll be able to interact with us, and we would love to hear your thoughts about what you think about this purchase.
If you leave the most insightful comment, Commonstock will pay you $100 directly for that.
We hope you found this video to be useful. Brian's out.